Right, good evening, everyone. Welcome to the next in our series of this year's inaugural lectures. I always say it, an important series for the university, a chance for the university to show off our sometimes nearly new appointees. Some people have been here over a year by the time they actually give their lecture, but nevertheless, our new appointees, and in particular to often emphasise the research that people are doing. And in this case, I think a new venture, actually showing how what we do really has both the promise and the reality of having an impact on the outside world. So it's a great pleasure this evening to welcome Gary Crowe to introduce his inaugural lecture. I will read this because Gary hasn't got the standard academic background, which is what I normally end up standing here and reading. So Gary was appointed actually in his role of Professor of Practice, Innovation and Leadership within our management school at the beginning of this year. And he's also the Director of the Mercia Centre for Innovation Leadership. And that in itself is part of the university's investment in that impact realisation from a lot of, and indeed our impact on the regional economy, which is something that in broad terms we're starting to get, I think, a fairly significant national reputation for. He is what is termed a practitioner expert, and that's in leading business transformation and innovation, and he has been working in business for over 30 years. He worked in NatWest, in the commercial banking business in the West Midlands, and was Strategy and Design Director for RBS's small and medium-sized enterprise business division, and a managing consultant, most recently at PA Consulting. He currently has a number of different roles on top of the role that he has here, including a non-exec director of a mutual regional building society, the Stafford Railway Building Society, and as a non-exec director and vice chair of the UK's largest NHS community healthcare trust, Staffordshire and Stoke-on-Trent Partnership NHS Trust. He originally studied at Birmingham City University and then completed his professional qualifications at the Chartered Institute of Banking and as a chartered banker. So today Gary will introduce his new role, because I think it's a new role not only for him but a new role for the university, so I think we'll all be intrigued by that. The Professor of Practice, as I say, is something that gives a credibility to a lot of what we do and a level of innovation in what we do. So it's a great pleasure in that context to invite him to give his inaugural lecture, 10 years on from the financial meltdown, rediscovering the leadership compass. Gary.
Thank you, first of all, for those generous words and for coming along this evening. When preparing for tonight, I think there's a little bit of a subtext to what I'm going to say, which is about reform and revolution. I decided it was safer to avoid the topics of religion and politics and stick to the less controversial topic of UK financial services. Well, actually that might be the rub, because in current times the role of finance and capitalism in general is a key societal theme. Now, before I come on to the financial meltdown and the leadership compass, I want to quickly cover a personal introduction and that of the role that I undertake here at the university. Having done my research, that's actually code for when you get out the embarrassing family album at the start of things. And these three pictures are three generations of my own family. The tall and proud gentleman here is my grandfather. My family is actually from a rural and farming community. I describe this individual as a rural entrepreneur. He was a contract farmer. He acquired quite a lot of the initial machinery used in farming and operated as a contractor to do work elsewhere. And he had a number of ad hoc ventures on the side, some of which I'd have to talk about in the bar rather than ones in public. My own So this gentleman here is my own father. He decided living off the land wasn't for him, and he moved to an urban life and pursued a corporate career in insurance. And I guess that's where the link with financial services began. And these three individuals, clearly you'd spot hopefully which one I'm. That's myself and my two sisters. And we were all ambitious, but in different ways. My eldest sister developed a career which accumulated in becoming a company secretary with a legal and governance role. And my middle sister actually joined HSBC at 16. And they've both moved away from England and actually live overseas. Now these are even better now. I thought I'd go for the ones with the full head of hair. And also, just want to point out, this wasn't November. That picture was actually from the 1st of July 1985. That was the day that I joined NatWest on a management development programme at age 18. And whilst I was from a financial services family, what really attracted me to this role was the educational element and the ability to progress while still in employment. I was fortunate enough to be on a contract which meant that I got day release immediately to firstly study what we were seeing now as a foundation course, and then a full-scale modular banking exams over 3 years. Well, it would always be at least 3 years, where I went to what was Birmingham Polytechnic, and it was the classic learning and earning model. This gave me a significant advantage as I developed my career, because at an early age I'd got significant knowledge and application, and I was able to achieve a number of career firsts at different age points, which I was very proud of, but very modest about equally as the time went along. My favourite subject at school was actually design and technology. And that was a discipline that I'd learned to love almost 25 years later when I took on a great role, which was Director of Strategy and Design. And I think that's actually what led me to journey towards a role in the university in the space of applied innovation. Post the financial crisis, it was certainly the necessity of the mother of all invention, and I led a number of innovation projects in financial services. I was very driven to make a difference, but ultimately I decided that spending a further 10 years, and I felt that's what it was going to take to turn the industry round, I was going to be best served by joining a management consulting firm, which I did. And then later I came to do things more locally, which I'll come on to. And this is the current generation of Crowes. You can see they're all much better looking than I am. Daughters Elizabeth and Catherine, my wife Julia. Unfortunately, they can't be here tonight. So they're actually all working. My two daughters are at piano exams, and my wife's employment means she has to work late. They're all far cleverer than I am, I can report, and determined to make a change for the world. They do all of sciences, and I've already told them I know a good local university that's strong in that area. Okay, so let me introduce the role of Professor of Practice. It is a new role for the Management School, and as has been mentioned, I'm not from a traditional academic and educator background, nor am I a research-based professor. I joined the university earlier in the year because of my business expertise in delivering innovation and transformation and working with businesses. My credentials are 30 years of business practice. Specifically, I've worked closely with over 2,000 businesses, from corporates to small and medium-sized enterprises, and working with entrepreneurs and those entrepreneurially minded individuals is actually something I enjoy immensely, and is absolutely a passion for me at the moment in the role that I'm now doing, which is actually creating a centre of excellence for leadership and innovation education, and also a broader ecosystem of innovative businesses. But my role is certainly a chameleon, but it has this familiar ring to it as anybody from a commercial background has: on time, on budget, on plan, and to the required quality. It is about bridging across academic colleagues, business owners and external stakeholders where we've enjoyed close support from the local authorities and the local enterprise partnership. We're helping each other to work together on mutual priorities of economic development and growth, skills development, and growing successful entrepreneurs, employment and enterprise. And I think I also must say thank you to colleagues from the Management School for making me feel welcome, the Curtis Director, Mark Bacon in Dry and Shane as Dean for supporting me in the appointment. Thank you all. Plus it's important to point out, I guess, that the European Union has provided funding partly towards the project, but I'm just going to skip over that bit at this point as a separate lecture. And why am I doing this role? Well, it's fundamentally about actually generating an impact locally, developing a legacy of innovative practice in the university and a contribution to the economic growth of the region. As a practitioner and a business person, my clear motivation is impact and legacy. They're highly motivational aspects for me personally. I want to say a little bit about introducing the work of the Mercia Centre. And this is the immediate focus of my role. It's initially centred on the development of an SME Business Leaders Programme aimed at leaders who want to grow themselves personally and their business through developing high-impact innovation and leadership practice. It's a 6-month development programme. It is a proposition which sits well within the university's broader strategic agenda for enterprise support and development, the employability agenda for students by fostering strong external ties and relationships, and as part of being a key regional anchor with a large and thriving science and innovation park. Over the initial 2 years, the aim is to support at least 75 innovation-intensive businesses and business leaders. It's based around 6 two-day workshops and a variety of connected themes, practical education, skills and support. Importantly, built into the programme is the role of business coaches or entrepreneurs in residence who support the embedding of the academic content and the material in the workshops meaningfully into practice for the individuals. It's this interpretation role. And I would like to salute their work and that of the Centre Manager, Andrew Bowker, for helping us get things off to a very successful start. It is a blended learning experience and journey for the business leaders. There are academics, external expert practitioners, industry leaders, and local SME business role models. There is equally very much a peer-to-peer support environment where different leaders take time out to review each other's issues and problems at work and come up together with solutions and ideas for the way forward. It's very much built on this platform of innovation and leadership, innovation being the successful exploitation of new ideas and the process that carries the ideas into action, with the leader's role focused on creating the culture to deliver the innovative practice and outcomes. And it's highly interactive. These pictures are from the first cohort, which finished, as I say, a month back, and the second cohort has just started. And I'm pleased to report at this early stage that we've had some excellent feedback on the progress so far. There's a strong willingness to recommend the programme to the peers, and from a business background, this is the killer question. How keen are you to actually recommend a peer? And we have had some excellent results here. 9.3 out of 10 in terms of recommendation, which converts into a Net Promoter Score for those familiar with this of plus 75. And that is, for me, absolutely fantastic and something I'm very pleased with. I'm also pleased to report another reflection from the first cohort, which is that participants are very interested in follow-on activity with the university across a range of areas, which promises well for future student placements, involvement in the events, and future skills and personal development courses we may seek to offer externally. Clearly also, I should mention that we'll have a longer-term research and impact that will have to follow beyond this initial assessment, but the signs are very encouraging. Okay, I've taken a bit of a time to introduce myself and do a little showcase really on the work of the Mercia Centre. Now I want to turn to talk to you about the 10 years on from the financial meltdown and rediscovering the leadership compass. This is not built from academic research. It's my reflections as a practitioner in the financial service industry for 30 years. I've worked for, with and consulted on projects at all the major UK banking institutions. And specifically, I did work at RBS head office for 5 years post-crisis, leading on areas of strategy design and innovation. It's particularly about the role of leadership and the leadership compass that I'm going to come on to. And I'll also take a quick look forward for the financial services sector. But let's start with a reminder of the key timelines in the financial crisis. History now serves to recall the start of the global financial crisis was the 9th of August 2007. That was the day that France's BNP Paribas bank stopped investors pulling money out of 3 investment funds exposed to subprime mortgages. Subprime meaning household loans to borrowers of higher risk. This created a fear that if one bank lent to another, you might not get your money back. And BNP could not determine the value of these loans in its portfolio. It fundamentally bust the business model of pretty much every bank which relied on borrowing funds from each other rather than on depositors to fund their business model. Weeks later, customers flooded branches of Northern Rock, the UK's 5th largest mortgage lender, after it became clear it had approached the Bank of England for a loan. And the Chancellor, Alistair Darling, needed to support the bank's liquidity as other banks basically weren't willing to lend any money to Northern Rock. And it was the first full run on a UK bank since 1866. The Bank of England replaced what was a money market source for the institution with their own funds, and ultimately Northern Rock fell into the state's hands in February. In parallel, RBS did still proceed with a long-term bid it had been making for part of ABN AMRO, an acquisition in consortium with others, which was sealed in the October of 2007. It shared £10 billion. And by April 2008, despite saying it had the resources to complete the acquisition, it did actually go back to the market for a £12 billion rights issue. 14th of March 2008, global investment bank Bear Stearns is brought out by JP Morgan, $240 million US dollars, at the time considered to be a considerable discount. What later happened showed actually it was way over the top. If we move forward to the autumn, 15th of September 2008 was a pretty substantial day. In the States, Bank of America says it was going to buy Merrill Lynch $50 billion. But unthinkably, on the same day, Lehman Brothers filed for the largest bankruptcy in history. And panic fundamentally breaks out in the market as Lehman Brothers had assets of $639 billion in assets. And the contagion that created across the market was sheer panic. My own sister was working on the other side of this at HSBC at that point, and she equally can tell the stories of carnage. 18th of September, HBOS, Halifax Bank of Scotland, was bought by Lloyds, and subsequently Lloyds Bank had a government bailout. RBS was bailed out by the government, who ultimately took over an 80% stake. And Alistair Darling is not shy to report the phone conversation he had with the RBS chairman, Tom McKillop, where the conversation went, how long have you got to last? Sorry, how long can you last? Well, we're going to run out of money in the early afternoon, was the conversation. After quantitative easing started, some of the societal impacts began to come about. The UK government needed to take on debts to shore up the financial services industry, and the UK economy was heading for difficult waters. In Iceland, well, basically the financial service industry collapsed totally, and if you can remember, the UK government had to actually step in to shield UK depositors. And by the March 2009, interest rates in the UK hit 0.5% and remained there for over 7 years until they actually fell further post-Brexit. Now, this graph here is seeking to really highlight this period in 2008 and 2009, and this is where some of the human impact of this story becomes apparent when you start looking through a different lens of the employee and the business leader. We have hundreds of thousands of staff in the UK banks caught in the reaction to this crisis. And it was happening at multiple levels. To unpick some of those, there was clearly significant worry for their job and job security. A lot of people in the financial services sector had enjoyed long service and were wedded to big pension commitments, which they were looking to secure. The share price is something to highlight and may not be immediately apparent, but a considerable amount of wealth of, I would say, the vast majority of banking staff at all levels was either in bank shares or in options that they had to buy further shares under save-as-you-earn type schemes. And I had numerous colleagues in offices that I worked with, and they were actually relying on the value of these shares to pay for such things as their current interest-only mortgage or plans for retirement. Personal feelings of anger and embarrassment and personal betrayal were very much to the fore, and these strong emotions were very, very difficult for people to deal with personally and those in management and leadership positions. Line managers were totally ill-equipped to deal with such questions that were being raised. The context was unprecedented, and they didn't really know what to do. And then began a very long period that we are, I guess, continuing to be familiar with, of bank criticism, headlines, and continued misdemeanours. And there is some very salacious stories in here. Certainly, the cooperative bank had some significant problems culturally and with individual circumstances. And then equally, Barclays had a number of CEOs that they went through relatively quickly to get to the current incumbent, who's in fact even been criticised himself for some involvement with a whistleblowing investigation. 10 years. 10 years of misdemeanours. 10 years of an impact on individual members of staff, though. So looking at the state of leadership and the leadership compass in 2007 in UK financial services. So I'm looking here at a moment in time before the crisis fully got going in 2008. And this is my broad generalisation. There was 4 domains principally. And the biggest influence on these domains was clearly the role of the line manager and local leaders. When you look at the risk domain, so the risk of personal consequences, the probability and the immediacy of impact to an individual if they were found out for doing something wrong. Well, broadly speaking, internal controls weren't tight and personal accountability was weak. When you looked at the character lens, did people consistently know what was right or wrong? Were you able to control your impulse and stop yourself going off the narrow track of good compliance and good conduct? Well, it's fair to say that the compliance controls weren't strong, and codes of conduct, which I'd been very familiar with when I joined the banking sector in '85, were no longer a prominent and key purposeful part of the appraisal process and the leadership discussions. Structurally, rules and regulations, I would say here that the rules existed, but there was deliberately ambiguity left in place and grey areas were encouraged. In fact, excessive risk-taking and misweighted reward structures were consistently allowed, and there was certainly a punch-the-air culture of actually being able to get through a very risky loan adventure and hit an apparent short-term target. And culturally, the way we do things around here, I can't say high ethical standards were consistently encouraged, and certainly some of the behaviours tolerated were in the unethical space. To summarise, it was a make-it-happen culture, and the unsaid element was don't worry, boss, and damages on the way. The results were rewarded, and the how was largely immaterial. If I take a walk through the prevalent cultural aspects, and this is a little bit of an advent calendar of stories that I could talk through, and just to pick some of them out to give you a sense of the culture that existed and how it actually came to life. Leadership conferences were definitely the top 150 or 200 at all the institutions. It was the most senior and the most important people, and some top performers. There was no thought to consistently including diversity, future succession, and new and outside thinking was not encouraged. Leadership challenge. Well, I can recount one story that sticks in my own memory. I was at one of these senior leader events, and there came the usual opportunity for open questions, and there were some positioning ones of good order. But I was of a different mindset. I was a conviction leader and believed that opportunities like this, it was my responsibility to ask the difficult questions that my team would expect me to ask. So I chose to ask a question about the final salary pension scheme that existed at that point, and question the speculation that it was about to change or even be closed. I could feel the stony silence and the hard stare, and I got an answer, and it did reveal something of the future. But interesting, when I reflect back and dig my memory banks, afterwards there was two schools of thought who came to approach me. Firstly, people who said I was nuts to ask such an awkward question, and the other was the quiet, well done, but they didn't actually want to be seen to be slapping me on the back and to be seen in that camp. I'll pick a couple of others out here. Buildings, well, there was significant investment in buildings in Canary Wharf for both HSBC and Barclays. I think the standout one for the industry was the world headquarters built by RBS at Gogarburn near the Edinburgh Airport, £350 million, completed in 2005, opened by the Queen, complete with its own access road, and it was a truly fantastic facilities, and included its own business school, and I was able to study there, but it was, with hindsight, an environment that was of its time and was completely over the top. Things which were noticeable was the thickness of the carpet on the exec floors compared to the regular floors in buildings. This carpet was thick enough that it actually got your shoes stuck in it, which was quite entertaining. I can also recall a story when I moved a number of teams into new buildings, and there was a regular event that occurred, which was a man would turn up in a van from Scotland, and this was the chap with the artwork. He'd turn up with the artwork, and you would have a day choosing what art went in the public space and what went in the executive rooms. And then he'd trundle back round to go and do another office. I'll pick some others out. Risk appetite, something that all organisations are now familiar with more and more. The appetite was actually how far outside policy could a lending proposal be sanctioned at. Credit committees, generally the bigger ones, didn't actually understand the lending proposal, and there wasn't a culture of counter-signature through the presenter, which made them personally responsible. And I think I'll just pick out this one here, stars, one that I personally really battled against. When misconduct issues were tolerated and inconsistency applied to so-called star performers, this was a real point of contention with me and other more ethical members in the senior teams, and it created much mistrust. All members of staff needed to be held to the same accounts. Regrettably, that didn't consistently happen. I think it's important to pull out one particular area for a little bit further comment, and that's reward. Historically in financial services, reward was a team-based contribution mechanism where payments of extra payments were made after losses were accounted for across the balanced business scorecard, people, financials, operations and customers. At the time, pre-crisis, it was very much short-term individual targets that drove actions and reward. It was about inputs which were easy to measure, and it did not consider how it was completed. And it drove a mindset and practice. When that was combined with the difficult culture that I describe, well, it's no wonder, I guess, the outcomes that were provided. I wanted to turn to look at some of the challenges that line managers were actually facing in what was an intense period. And some of my own reflections when I've thought through some of the conversations that I had. Well, if you can just imagine for a moment, it might be a room maybe not quite as grand as this, but maybe of a similar size, when it was necessary to stand in front of hundreds of staff seeking to explain what was going on with their business and trying, in the difficult headlines of September and October 2008, trying to make sense of an industry and business in free fall. Half of my briefing came from the front page of the Financial Times, and the other the internal memo from head office to seek to present the case and the facts. Questions kept coming about job security and even whether people were going to get paid the following month. And as I mentioned, line managers were simply not prepared for their level of questioning and the difficult conversations that they'd had. They'd been growing largely on a command and control culture with KPIs to be monitored and delivered and little investment in staff well-being. So the leaders' approach on the ground, well, they began effectively to develop their own toolkit and approach. It was a circle the wagons, first of all, huddle together for loyalty to each other, keep an open conversation built on local trust about what was actually happening, regular communications in a very open fashion, and if you didn't know, you said you didn't know. It was survival. Reassurance was provided by the government's action to support the general industry, but there was significant anger at an individual level about who was responsible and how was it allowed to happen. And as the change necessary began to dawn on the industry and the individual staff, it became clear that there was going to be a significant period of change that was required. It's turned into over 10 years. People were asked to focus on what they could influence. Focus on your customers. Enjoy the time dealing with your customers, your clients, and the role that you had to serve those. And for most people, that actually provided significant reassurance, because typically customers were not blaming individual members of staff that they dealt with day to day. In fact, there was lots of cases of staff that I know who were rung up by good customer contacts inquiring about their welfare and well-being. And it was a certain irony that that was happening from an external call rather than some internal contacts. The road ahead was clearly going to be long and difficult. New ways were necessary to recognise and reward people, and a simple thank you began to go a very long way rather than a financial reward. Societal contributions and links were there for some of us to fall back on. I had enjoyed a long association with many local charitable causes and was pleased to be able to actually take teams out to do community work, and things like improving gardens for local good causes was a light relief from some of the difficult monotony in offices. Hygiene factors in the office needed to be held up, and consistency in contact and one-to-one discussions were vital to keep people's energy to a level that they could keep going. One interesting point was autonomy and empowerment. I actually began to be involved in what was a new experience where people were actually handing autonomy and empowerment back. They weren't willing to actually accept what they were being asked to do over and above their role, and physically told me so. And what's begun to happen, and what began to happen after the crisis and in the next period, was some real thought around purpose. Be good, be better, and apologise. Safety was achieved in most organisations within a few years with strong recapitalisation. A new sense of belonging needed to be established, with new symbols of reliability and integrity established, and pride was developed through return to customer stories of support and case studies of examples of helping people achieve things individually and in their business. Self-belief needed to be rebuilt, and an air of confidence in the competency and integrity of each other and leaders was beginning to come through. Whistleblowing was a policy that needed to be overhauled and introduced, and it's got real echoes of the healthcare sector at this point, and it needed to be applied in such a way that there was finesse rather than bluntly at times. I mentioned the return to societal good and staff support through initiatives like mental health. I was pleased to see coming to the fore in the industry. I also remember one particular example, which was a little card. It was called the Yes Checklist. And it was a short 8-point ethical decision-making list that people were asked to carry at all levels, but particularly senior leaders were asked to practice picking this card out of their pocket, putting it on the table in meetings, and consciously checking ethical decision-making was occurring. Interestingly, it made me reflect on one of the earliest experiences that I had with NatWest was a similar checklist that did exist in the late 80s, but somehow it fell out of use. I think it's important to mention some of the regulatory requirements. Certainly the senior manager regime that exists now, which puts into statute responsibilities for senior leaders in the financial services sector with cast iron accountabilities. No longer a sense that people could slip away without feeling accountable. Significantly beefed up roles for non-exec directors, and a regulator in the PRA who would proactively inspect and review. Most recently, I was subject to a PRA annual visit at the building site I'm involved with, and this is now, I can tell you, a vigorous review process, including an annual declaration of fitness to practice, which consists of multiple questions and declarations. New banking licences were encouraged actively by the Bank of England. There was active signposting of alternative sources of finance that was available. New capital requirements were introduced. Account switching was supported in the sector. And the logic here was hopefully it was going to be akin to moving your mobile phone. And to be fair, it's not really worked. Despite cash incentives of several £100s that exist between different current account providers, last year only 1 million of 70 million current accounts actually moved, and this September was actually a record low for movements. Business Banking Insights now exists, which is an independent record of the performance of different banks supporting small businesses. And these last two, well, there's a hope that these two actually might be some game changes. Open banking is the requirement for banks to share data and information flows between organisations to allow customers, for example, to see all their accounts in one place. Customers have the option, though, to do this. It's not going to happen without their consent. And, for example, business owners will be able to share their credit rating and credit history with one institution automatically with an alternative lender to speed up the process, and also the ability to compare rates and terms rather than the current processes that exist. Remote deposit capture is something that's made a significant impact in the States. This is the ability to digitally take an image of a cheque and use that to clear rather than relying on a paper record. This is coming through next year, and you will have seen some of those annoying slips of paper which come in the post to you from financial institutions outlining this change. Broadly, this will mean the clearing of cheques will be reduced to next day in most cases, will be a digital image, as I say, rather than paper, and it will significantly open up access to new entrants to the clearing cycle, which was a restricting element to new entrants. It's still to be seen whether this will be enough to make some of the differences that the industry and the regulators seek. And I wanted to return to this societal good role that some financial firms have actually begun to hook onto. And I'm not wholly sure it's yet completely landed. If I look at NatWest, it had helpful banking. It then had a customer charter, which it dropped in April 2013, and included a commitment to close, which had included a commitment not to close banks, the last bank in towns, which fell away. We are what we do. Lloyds, does anybody really care they've been beside you for 250 years? Not sure. Nationwide, consistently as a mutual, they would like to believe, and evidence says they've shown strong local values and impact and a commitment to the longer-term support of their members, and have coined the expression building society nationwide. They're probably as close as it gets currently to a strong ethical stance in their material. I wanted to just quickly flick this slide up where it reflects on the institutional performance of the leadership styles through the ages. And we've moved from probably what could be described as institutional arrogance to survival and support, and now are seeking a desire to be authentic. But there are significant headwinds. And now, just to probably bring us to the current status, after all these actions, many of them imposed, where do I see the leadership compass now? Consequences clearly do exist for misdemeanours. Under the senior manager regime, there are major consequences for senior individuals. Character. Personal accountability exists strongly with individuals, and they know they have to be responsible for their own fate. There is a growing conviction to do the right thing. There's been massive reviews on structure and regulation. Guidelines have moved to rules, and some would argue the industry has become over-regulated and over-capitalised. And there's no doubt that this can create an environment which stifles innovation and customer choice. However, this is the choice that is necessary to return the industry to a sounder footing. Cultural norms. Well, pretty much every CEO has been replaced by a new culture and a new regime. So Fred Goodwin was cast as the original villain. Bob Diamond, appointed after the financial crisis, it was only in place for a short period after his association was cast with the libel scandal. These classic individuals have been replaced. And broadly, I would say, value creation of the set that's sought by society is still work in progress. I believe we are, as an industry, beginning to get there. But society is far from convinced. So what for the future? Well, for incumbent financial service businesses, particularly the mutuals, all is not lost. The building societies rate highly on their ability to serve customers. And this is an example of an external report. But shortcomings, failings and fines continue to pile on in the news. You've got the double insult of not only PPI claims being made, £40 billion in provisions, £40 billion in provisions from PPI claims accumulated so far, but you've got the added dimension of actually complaints being mishandled and fines being levied against the fine. There remains outstanding disputes to settle with the US regulator, and there's new risks which continue to emerge, not least cyber. These issues can pile up on organisations and continue to strain resources and need to be managed. Looking ahead, the competition is growing and becoming more intense. Choice is beginning to be created, certainly for most individuals. And here, in this group, we have a number of what I would call scorned leaders. Scorned leaders, people who used to actually be involved in some of the larger financial institutions and personally are highly motivated to bring change about and make a big difference. This first individual here, I used to work with in Birmingham, is the CEO of Sainsbury's Bank. Spent 10 years building the Principality Building Society and has now gone to Sainsbury's. Very, very capable individual, making a big change. They know how to handle data, they'd like to believe, and have got big customer bases. I've got two individuals on here which were ousted from other organisations. At Secure Trust, Shawbrook, Aldermore, TSB. These are all institutions which have actually accepted significant external investment funds during this year to provide them with additional resources. However, mergers look vital to give them the scale they're going to need. Others point to the FinTech market as an opportunity where technology will provide the disruption necessary to financial services. And I know you can't read this cartoon, but in that market you have people who think significantly differently to the incumbents. They take a view that banking is a commodity that if you wanted to buy a new home, which is this cartoon, you could go in the future to take a virtual tour of the property in the property agency, use your wristwatch to download your financial information, liquidate your deposits, secure a mortgage, share the necessary information paperlessly with the other parties to the transaction, and then ultimately use a fingerprint or other retina type identification to allow you to complete the exchange and the deeds, with an aspiration that potentially this ought to be possible in 20 minutes. Disruption. Well, there hasn't yet been an Amazon of banking moment, nor the Netflix type impact that's been similarly seen on TV. We mustn't forget that the UK current account market is mostly benched on a free-to-use service. It's the other services, the mortgage and credit card business, where the profits are to be made. Ultimately, there is strong customer inertia to move banks and providers. However, there are some disruptors here making some headway. The peer-to-peer lending market is growing significantly and has provided lots of choice to connect investors and borrowers directly. There are elements who argue that this is actually less well regulated and is a brewing problem. PayPal, we all know, has significantly changed the use of payments in society. Oak North, an organisation you probably haven't heard of, is a regional SME lending bank, but it's established and it's profitable quickly within a couple of years. This model does exist and is likely to continue. Neighbour is a call out actually to this county. This is actually a business that was seeded by the police mutual insurance business in Lichfield Staffs. They put some seed money into a new lender with the proposition that they would lend to the police and other service individuals on the basis that they would repay from their salary payments at source. This model has proved to work well for them as individuals and represents a significantly reduced interest cost for them on unsecured lending compared to what was previously possible for these individuals. And most recently, a sign of their momentum is Goldman Sachs have announced plans to put £100 million behind it. And Habito. Well, these are the guys who believe that mortgage deal is possible in the way that I described. That's an online mortgage broker, completes whole of market, it's paperless, and they want to considerably change the way things operate. So where am I left? Well, I'm left with a sense that the incumbents remain behind the curve with understanding truly the customer's requirements. Some of their technology thinking is of the now rather than the future. Augmented and mixed reality cases are not really in their thinking. It's only really online, mobile and some digital services. They're in the now rather than the future. People have begun to rush towards collaboration ventures and accelerator sites in innovation centres across the UK. And this rocket space, actually based in Islington in a former RBS building that I worked in, have got a successful model of completing this in the States. The Align business in the middle have come from the Barclays Accelerator. So people are reaching out in the financial services sector for alternative viewpoints. And I think it's worth mentioning that this type of mindset and approach actually bodes well for our own aspirations at Keele to have a smart innovation hub within a new Keele Management School building that will allow us in our region to create an environment for innovation and mutual working between businesses. And just as I thought maybe the financial service sector were waking up and making the progress that was necessary, I read this article on Friday. And it reported that Britain's financial industry is ready to transform itself. I cannot believe this article was written last week. Not 10 years ago, not even 5 years ago. This is an industry representative seeking to actually call out an industry is ready to transform itself. That message and requirement has long since gone as being necessary. So, to conclude, you have an industry which is going through continued change and turbulence. And who's going to preserve and win? Well, the incumbents, the challengers and the new entrants will be duking it out. The incumbents believe they've got the customers, the data and the scale. The challengers can lower costs, they haven't got the legacy and they can make a difference to society. And the new entrants think all those others are nuts. We're just going to do something completely different. But what I do put forward is this final thought, that the leaders in financial services businesses in the future will be those with a strong leadership compass. They will be the winners. Built on trust, credibility and competence at the core, a valued service proposition and a culture which sustains them to do good and be better than the practices of 2007. And I leave you with a final thanks for coming along. It's 34 days to Christmas. We all better start getting ready. Thank you very much.